Hello guys, welcome to Tutorials on the Go. My name is Edmond and I'm just excited coming your way with another lecture. Now, do you know that there's a Chinese saying that goes like, the faintest ink is better than the strongest memory? It goes to buttress the point that everything is best documented than just boxed up in our memory. Now, in today's lecture, we are going to talk about financial reporting. We'll talk about financial reporting. We'll start with the characteristics of financial reporting. Then we'll move ahead to talk about reporting entity, what a reporting entity is. Then we'll talk about the accounting period, recognition, derecognition. Move ahead to talk about financial statements, look at some extracts and its elements. Then talk about accounting equation. Then finally, the duality concepts. So just stay put. It's going to be educative. So what is financial reporting? So the objective for financial reporting is to present useful information in standardized reports called financial statements to assist or aid users in making relevant decisions concerning their interest in the business. So the decisions will involve investment and or financing and or voting or influential management decisions depending on who the user is. So shareholders will make investment decisions. Banks or lenders will make financing decisions. Management or shareholders will also make voting or influencing management actions. Now we'll look at characteristics of financial statements. We'll look at the first two fundamental characteristics. That is, the ones that each and every financial statement must have. The first one is relevance. So an information or a financial statement will be relevant if the information will help in the decision-making process of users. That is, it must have confirmatory value, that is, captures past events or every activity in the period. It must also have predictive value, that is, have the potential of assisting users in deducing future or possible events. The second fundamental characteristic is the faithful representation or reliability. So the information must accurately report on the elements of the business, that is, assets, income, capital, expense, and liabilities. We'll be discussing elements very soon, so don't worry. So for the information to be reliable, it must be complete, that is, capture all the transactions in a particular period. It must secondly be neutral, that's free from bias, and must not be misleading. And finally, it must be free from significant or material error. We will now be talking about the enhancing characteristics of the financial statement, the ones that are nice to have. Okay, we'll first talk about verifiability. So this is the extent to which information is reproducible given the same data. It means that when you give the same data to different practitioners, the result should be similar. It shouldn't be differing. Timeliness. Information is less useful or relevant the longer it takes to be produced. All the users have a period for which they'll be requesting for the financial statement. Management might be requesting for the statement within a week, a month. Government or customers will be requesting for the statement at the end of the year. Shareholders, the same. So if a management is requesting for a weekly report and maybe you present it 2 weeks later or in a month, the information that will be produced will lose relevance. Okay. The third one is understandability. So information here must be understood by the average user. So it must be supported by pertinent, additional, and supporting information to help in that regard. Let's talk about comparability, the final enhancing characteristic. So accounting policies and standards must be consistently applied throughout each period. So that way it makes it easier for users to draw trends, come out with similarities and differences to be able to make informed decisions concerning the performance and the position of the business. So financial statements should also be able to be compared to other entities. So not just comparing the position or the performance of the entity to prior years, it should also be able to be compared to other entities, especially in the same industry. Now we are talking about a reporting entity. So what is a reporting entity? So a business with the obligation to prepare and present financial reports. So the report must be general purpose financial reports, which is meant for the benefit of all users of accounting information. So here the reporting entity is supposed to prepare report for all users. You don't prepare it because one user has requested for it or you have one user particularly in mind. If it is for one particular user, then it's not a general purpose financial report. So some of the users, example, shareholders and government, are to be presented with a report, while others may access it via the business portal. So by virtue of some of the users, the reports are supposed to be given to them. Others will also have to take the proactive step in receiving it. So a reporting entity, every business is a reporting entity, some by law or some by best practice. Okay, so let's move on to talk about accounting period. So the accounting period is usually 12 months, over which a set of financial statements are prepared. So the accounting period is the period within which a reporting entity is supposed to prepare and present financial reports. So any accounting period that ends on 31st December is termed as a calendar year. So a year that begins on 1st January and ending on 31st December of a particular year is a calendar year. Any other accounting year or any other accounting period that ends on a date other than 31st December become a fiscal year. So when you have an accounting period beginning on 1st March of a particular year and ending on 28th or 29th February the ensuing year, because it's not ending on 31st December, it becomes a fiscal year. So some accounting period can be for a month or a quarter, depending on which user is requesting for the information. Recognition is the process of including an item in the financial statement, such as purchase of an asset, and is appropriate if it results in relevant and faithful representation. Now, the financial statement must capture every activity or every asset or resource that is being used in the business. That way, it is called recognition. So, derecognition, on the other hand, is removal of part or all of the information. So, when an asset is sold, it is ideal that it is taken out of the books. A business cannot be reporting on an asset that is not in use. Now we talk about financial statements. So these are general purpose financial reports, as we spoke about earlier. So they are general statements meant for the use of all users. So the reports are prepared neither for a particular user or users, nor at the request of any in particular. So the main financial statements are income statement, also known as the profit and loss account, statement of financial position, also known as the balance sheet, and cash flow statement. So the report covers the entire operations of the business, not focusing on individual units or products or department. The report captures the summary of total activities in an account. So for example, the sum of individual activities on sales are presented under the revenue account. So you don't see the individual activities being featured on the financial statement. No. The sum of them, or the summary, is what is featured in there. So the report is also prepared based on the elements of financial statement, which we'll be discussing very soon. So let's look at the extract of the financial statement. The first one that we'll be looking at is the statement of profit and loss. So therefore, for profit and loss, the main criteria is that it is prepared for a particular year in isolation, meaning that informations are not brought forward from previous years and informations are not carried into the subsequent year. It is prepared for a particular period in isolation. So that's why the statement captures it as statement of profit and loss for ED Spices for the year ended, because it is for a particular year. It is captioned, or it is questioned for the year ended 31st December 2020. So you have the sales revenue, then we have the cost of sales, that is the cost of the items that were sold to generate the 1 million. So we have the opening inventory, the amount of inventory that were available at the start of the year. We have purchases, the additional inventories that were brought in, totaling $350,000. Then we have the closing inventory. So here the closing inventory is amount of inventory available that were unsold. So when you take the closing inventory out, it will give us the idea of how much inventory were sold to bring in the revenue of $1 million. So the $310,000 becomes the cost of sales. So when you take the cost of sales out of the sales revenue, you get $690,000. That is the gross profit. Then you have other income. When we get to the element, you understand all these terminologies. So you have rent received, interest received. You add it up to become $150,000, and because it's an income, you add it to the gross profit, giving you $840,000. Then you bring in the expenditures. You have rent, you have electricity, you have telephone, you have wages and salaries, you have motor expenditures. There might be other expenditure, but there's an extra, so we just capture a few. So totaling $130,000. So because it is an expenditure, it is taken out of the $840,000, giving us a net profit of $710,000. So for the calendar year ending 31st December 2020, ED Spices generated a profit of $710,000, which they will be paying tax on and further distribute some to the shareholders of ED Spices. Well, let's talk about the statement of financial position. So unlike the profit and loss account, which deals with periods in isolation, the financial position deals with periods in continuum. So here, items are brought forward from previous years, and the result of a particular year will also be carried forward into the particular year or the following year. So here, another feature of the financial position is that it is broken into two parts: the asset at the upper column, the capital and liabilities also at the bottom. So here, the system is that all the assets of the business is either funded by the capital, that is the money contributed by the owners, or liabilities, say loans or goods given by suppliers or bank overdraft and what have you. So the upper part must balance with the bottom part. So you have non-current assets, the total of which giving you 4.5 million. You have current assets also giving you $500,000. Add the two, which give you the total of the assets, giving you 5 million. Then you come to the capital column, which is giving you $4 million. Then you come to the liability column, which is also giving you 1 million. So when you sum the bottom part, which is the capital and liabilities, you get 5 million, which equals the asset. It means that it has balance. Anytime you prepare a balance sheet and you don't have equal figures for both parts, it means that there's an error somewhere. There might be an error when it balances, but it is more glaring when it doesn't balance. We will now be talking about the elements of the financial statement, the first of which is an asset. So an asset is a present economic resource controlled by the business, arising out of past events, which has the potential of bringing in economic benefit. So when we say a present economic resource, we are saying that any item of value that can be used in generating economic benefit or further assets. It is controlled by the business because it is the business that determines how it is used to generate this benefit. It arises out of past events, maybe because the asset was bought or it was gifted to the company or it was leased or it was contributed by the shareholders or the owners. That is why the asset is in the business. So due to those circumstances, the asset is in the business. Then the business has the potential of bringing in economic benefit. So for example, let's take a motor vehicle. A motor vehicle is a present economic resource because it has a value. It was bought or leased or exchanged at a value, and has the potential of bringing in future economic benefit because the motor van can be sold or used in the course of the business to bring in money. It is controlled by the business. If the motor vehicle's usage is determined by management of the business, then it is an asset. Also, if it is arising out of past events, you can trace the existence of the motor vehicle in the business to maybe a purchase or a lease, then it is an asset. Then if the motor vehicle has the potential of bringing in economic benefit, so if the motor vehicle is bought and it cannot be used, cannot be considered as an asset. So any item that fails any of these criteria fails to be an asset. So an asset is broken out into two parts: non-current assets and current assets. Non-current assets are those items that are supposed to be used or controlled by the business for more than 12 months. So we have property, plant, and equipment, examples of which are land, factory building, motor vehicle, machinery, office computers. We also have intangibles, which are assets without physical substance, so like goodwill, franchise, software, intellectual properties, etc. We have investments, money put in portfolios or other businesses with the intention of keeping it there or retrieving benefit from it for more than a year. It's a non-current asset. We come to talk about the other part of it, an asset, which is the current asset. So an item which is to be used or controlled by the business for less than a year, that is 12 months, is a current asset. So examples are cash and bank, that is money is available or kept in a financial institution. We have receivables, people who owe the business. We have items bought or manufactured for resale, which are inventories. We have short-term investments that are supposed to be terminated or recouped within a year. Then we have prepayments. These are expenses paid in advance. So when you pay 2020 rent in 2019, it becomes a prepayment. Or you are in 2021, you are paying rent for March, but you are in January. That's February and March rent is a prepayment. Now, one thing to note is that an asset which is current for one company will be a non-current for another company, depending on the intention or the purpose for which it was brought into the business. A car showroom company, so a motor vehicle for a car selling company will be a non-current asset because it will be an inventory. It is supposed to be sold within a year. A motor vehicle for a school or a grocery shop or a supermarket will be a non-current asset because it's going to be used in the generating of money for the business for more than a year. It was not bought to be resold, but it was bought to be used to generate more benefits. Also, two items of the similar nature can be differentiated into, or can be separated into, current and non-current. So the same motor vehicle example, let's say a car dealership company. So they might have cars that they will be selling, and they will have a car or cars that they use in running the administrative day-to-day activities of the business. Okay, so the same car, so let's say a van, they have two types of van. One is used in administrative duties of the business, which is a non-current asset. One is purposely to be resold, which will be a current asset. So two similar items in one business, one being categorized as non-current, the other being categorized as a current asset. Let's talk about liabilities. Now, if an asset is an economic resource, a liability is a present obligation, a duty to settle debt or pay money to somebody. It arises out of past events. So maybe you bought an item on credit, or somebody has given you money to use in your business. So because of that circumstance, it becomes a liability. Transfer of economic resources. When you are supposed to free yourself of that obligation, it will lead to either money or other assets or resources going out of the business. Let's take one example and pass it through this criteria and see if it will pass. We'll look at payables, creditors. It's a present obligation because you owe them an amount of money or a duty. It arose out of the past because you probably bought something from them on credit. Now, a transfer of resources means that when you finally get to settle the payable, it will lead to either money going out or another asset going out to settle it. So we have two forms of liabilities, the same with the asset. So you have non-current liabilities, which are obligations to be settled over 12 months. Examples which are preference shares, long-term loans, example debentures, lease obligations. Current liabilities, on the other hand, are obligations to be settled less than 12 months. So we have overdrafts. That is a temporary negative bank balance. We have payables, amount owing to suppliers or other third parties. You have accruals, overdue obligations. So when you have a rent to be paid in January, but you pay it in March. Short-term loans with a repayment period of less than a year. Prepayment, money received now for services or products to be discharged or delivered in the future. So for example, when you receive a rent from your tenant for March, but you are in January, it means that rent is a prepayment and it's a liability because you have taken the money now. If the tenant decides not to occupy the rent again, you are supposed to give the money back to the tenant. So it becomes a liability. We're not move on to talk about the third element of the financial statement, which is equity or capital, which is the owner's fund. So capital is also known as net assets, which is the difference between total assets and total liabilities of the business. Capital can be an initial contribution at the time that the business was being formed, or money is contributed later when the business was up and running. Profits increases capital and losses decreases capital. So the profit that is generated through the profit and loss will be brought into the balance sheet to be added to capital. A loss incurred or a loss arrived at in the profit and loss will be brought into the balance sheet to reduce capital. Drawings, that is money paid to sole proprietors, will reduce capital. The same with dividends, money paid to shareholders of a limited liability company. So we'll next discuss income. So income is an increase in economic benefits during the accounting period in the form of an increase in assets or a decrease in liability, which results in increase in equity other than contribution from owners. So any money that comes into the business, that is not coming from the shareholders. That is not tying the business to an obligation. It's an income. Income can be broken down into revenue and gain. So a revenue is an income that is derived from the ordinary course of the business's operation, or what the business has been formed to operate. So when you have a school receiving fees from its students or receiving fees from parents of its students, it's a revenue. Gain, on the other hand, are increases or benefits that is derived from means other than the ordinary course of the business. So for example, in the school example, when a business sells an asset and makes a profit on it, it is not a revenue, it is a gain. Or they receive a donation from well-meaning citizens. That is not what they are set up to do. So it doesn't become a revenue, it becomes a gain. Expenses also are monies paid or cost incurred by the business in order to generate income. Expenses are also broken down into expense and loss. So expense are obligations settled or incurred through the business's ordinary course of operation. So rent of office building, electricity, stationery, transportation, staff remuneration, etc. So loss also are those obligations from other means. So when you have inventory going bad, when you dispose of an item and you make a loss on it, it becomes a loss. You understand? It's an expense, but it's a loss. So all these items will have places where they will be fixed in the financial statement. So now one thing to say here is that a revenue for one company can be a gain for another company. So for example, a company that sells cars, when they sell car and they get the money, it will be a revenue. But a school which sells its car will be a gain, not a revenue. Okay. Let's talk about the accounting equation. So all elements of the financial statement are captured in the accounting equation, also known as the balance sheet equation. So the accounting equation states that all the assets of the business are funded by either its capital and or its liabilities. Hence the formula assets equaling capital plus liabilities. So income and expenditures lead to profits, and withdrawings, they affect capital. So when you have an income and expenditure and you put them in the statement of profit and loss, you derive a profit. The profit is moved into the balance sheet to be added to the capital. So when you also have drawings and you have dividends, it will also go to affect the capital. So you see how all the elements of the financial statement is featured or captured in the accounting equation. Accounting equation hence forms the foundation of the dual concept, which we'll be discussing next. Now, the effect of all transactions must lead to the balancing of accounting equation at all times. So the effect can be in three ways. One, increase and decrease in assets. So we'll now be focusing on the left side of the equation. So asset goes up by say $100, it will also come down by $100, which will leave the accounting equation balancing. The second effect is that an increase in assets, so the left side of the equation going up, then an increase in capital or liability, the right side also going up by the same figure. It will leave it balanced. The third and final effect is that a decrease in asset, the left side coming down, and a decrease in capital or liability, the right side also coming down, which will make it balanced. So we are going to look at the final topic for this lecture, which is the duality or double effect of accounting transaction. Now, a transaction in accounting refers to an interaction between the various elements of financial statements. For example, when a business purchases a machine on credit, the transaction is an interaction between assets, that is the machinery, and liabilities payable because it was bought on credit. So every transaction therefore has at least two effects on the element of financial statement. Thus, the dual effect. So the effect, as we spoke about earlier, can be within one element, asset and asset, or across multiple elements, asset and income, or asset and equity, or asset and liability. Okay, let's take some examples on dual concept to drum deep the discussion that we have had so far. The first of it is the owner puts $10,000 into the bank account for the business. So the effect will be that assets, which is the bank, will increase by $10,000. Capital, which is the owner's contribution to the business, will also increase by $10,000. So you see that the left side of the equation goes up by $10,000. The right side of the equation, being capital, also goes up by $10,000. So it will leave the accounting equation to balance. Second example, the business buys a shop for $2,000. Effect, asset, which is the building or shop, will increase by $2,000. Asset, which is the bank, will decrease by $2,000. So this is an effect within an element. So the left side goes up by 2,000 and comes down by 2,000. It must leave the accounting equation to balance. Third example, the business buys goods meant for resale, meaning it's an inventory, for $10,000 on credit. Effect, asset, which is inventory, will increase by $10,000. Liability, which is payable, will also increase by $10,000. Left side going up, right side going up by the same figure. A balancing situation will be arrived at. Next example, the business buys a motor vehicle for $2,500. Dual effect, asset, motor vehicle, increases, and asset, bank, decreases, an effect within an element. The fifth example is that the business sells half of the goods bought for resale for $10,000 check. Now, there were goods in the third example. Realize that they bought some goods for $10,000. They are selling half of them. So income, which is revenue, because they are goods meant for resale, will increase. And assets, which is bank, will also increase by $10,000. Income will move into the balance sheet to be added to equity, consequently. So it means that capital will go up by $10,000. Assets will also go up by $10,000. Next example, the business pays off goods bought on credit. The dual effect will be that asset, which is bank, will decrease because there is a payment, an outflow of cash. The liabilities, which is payables, will also decrease by what? $10,000. Seventh example, the business pays the sole proprietor $1,000. Dual effect, asset bank reducing by $1,000, capital in the form of drawings also reducing by $1,000. The business sells motor vehicle for $3,000. Now the motor vehicle was bought for $2,500 in the previous example. So the dual effect now will be that asset, which is motor vehicle, will reduce because it is being sold out by $2,500 by its cost. Now because there has been a $500 gain, income, which is not revenue but a gain, will now increase by $500. Then bank will increase by $3,000 because money is coming in. So realize that assets will go down by $2,500 initially. Then it will go up again by $3,000 when the money comes in. So a net effect of $500 will be standing in, which is an increase. The corresponding increase will be in gain, which will consequently end up in capital. So the net effect is that assets will go up by $500, capital will also go up by $500. And ideal situation for the accounting equation. The ninth example, a business pays electricity for the factory for $200. Dual effect, assets will go down by $200, expenses will increase by $200. Now, expenses going up by $200 means that there's a possibility of a loss arriving. So the loss will go and reduce capital. So the net effect is that assets will go down by $200. Equity or capital will also go down by $200. Final example, the business sells goods meant for resale on credit for $1,000. The dual effect is that assets, which is receivables, will increase, and income, which is revenue, because the goods were meant for resale, will also increase by what? $1,000. The net accounting equation will balance. So this brings us to the end of today's lecture, and I hope everything that we have discussed has made meaning or has made sense to you. If you have any reservations or comments or questions, do hit our social media handles on YouTube, Facebook, Twitter, and Instagram, where they handle DW Consult, and drop all your concerns there, and I'll be more than glad to address them. Thank you very much, and stay blessed.